Huge dividend increases that you need to know about, with one company increasing their dividend by 50% this month. We're going to run through each one of these companies, their historical performance. We'll look at their dividend safety. We'll run into their financial metrics. And as always, we'll even put them through the valuation model, getting to our intrinsic value and finding out our acceptable buy price given our investor margin of safety, and see what Wall Street are forecasting over the next 12 months. The first huge dividend increase comes in the form of the Hershey Company, ticker symbol HSY. They increased their dividend by 15% this month. They're currently down 19% over the last year. Over the last 10 years, however, you would be up 81%, but that doesn't include those dividends reinvested. We see their all-time highs of $275, and they have been coming lower and lower over the last few months due to the increase in those cocoa prices. We do see them towards their 52-week low with a forward yield just under 3%, a forward PE sitting around 20, and when we look at their dividend safety, we have a very safe score of 93, market cap just under 40 billion. It is a large cap company. In terms of those recessionary metrics, well, they maintained the dividend during the 07-09 crash, above average growth, negative 0.1% versus the S&P's negative 12, and they also outperformed the S&P negative 30% versus the S&P's negative 55% recession return. As we just mentioned earlier, 15% increase this month, 10% increase over the last 5 years, 10% on average over the last 20 years. Very, very strong. We love double-digit increases. And we can see they have been increasing those dividends for the last 14 years. And in actual fact, paying dividends without a reduction for the last 94. Dividend yield theory then states the company is undervalued when the current yield sits above the 5-year average, 2.81 versus 2.03. So we have our first sign of undervaluation. We have a double sign with the forward PE 20.3, lower than the 5-year average of 24.3. But do bear in mind, we don't look at any of these models in isolation, and we will conclude towards the end. In terms of the sector P, consumer staples does sit a little lower at 18.7. For those that are new to the channel, we focus on the free cash flow payout, as earnings is susceptible to manipulation by management through accounting. Below 70% if you want to be industry specific for consumer staples. My personal preference, a blanket 60% approach. That gives me faith that management are able to effectively allocate their capital. Over the last 10 years, pretty much consistently below 60%. The last 2 years, 44%. 2023 expected 54%. 2024 at that 60% level. Free cash flow per share, nice to note the increases is increased more than 4 times over the last 10 years. Very consistent, 213, 880 in 2022, although we see it expecting to drop in 2023's full year accounts, but then rebounding to 907 in 2024. Top line growth, as always, 3 to 7% for steady moderate growth. The last 3 years, very strong, and even before that, you could say a little bit inconsistent, but we can take some faith in the more recent period having some nice numbers. And numerically speaking, 7.4 billion to 11.2. Shares outstanding, they do return some excess cash to investor pockets by buying back shares, although not a massive amount, 225 million in 2014, 206 in the latest period, buying back around 20 or in fact 19 million shares. ROIC, love it when this is above 10%. That is one of my 7 golden dividend metrics. I want to see 10% or more, as it gives me faith that management are able to effectively allocate their capital. Talking of my 7 golden dividend metrics, it is one of my essential newsletter articles. If you do want to grab a copy, they are completely free to sign up. Click on the pinned comment below. Every week we run through one different topic. The latest article was running through insiders who were buying a lot of shares of their company, as well as looking at those that were selling shares. Moving back then to Hershey's ROIC, we do see that whilst it is very strong double digit, it has been decreasing over the last 10 years. Nonetheless, very solid 29% in 2023. Operating margin, free cash flow margin, very strong above the minimums that we look for, and it has been increasing, so their operating efficiency is becoming better. Likewise, the same could be said for the free cash flow margin, so no red flag indicators to note there. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization. This correlates to the dividend safety as well as balance sheet strength. We want to see below 4 for consumer staples, and these are the number of years it would take the company to pay off all of their debt net of cash on hand. 1.45 in 2023, looking strong, expected fairly similar in 2024. No real worries with their dividend safety or their balance sheet as well. So let's jump into the valuation. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we run through every single one of these valuations. Today's episode, we're going to jump straight into the final intrinsic value calculation, and we can see for Hershey today, it's coming to $245. Now, the current price at $195, we start off typically with a margin of safety of 10%. We use this if it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. If we believe that for Hershey, it's a buy up to $220. At 15%, still a buy up to $208. At 20%, pretty much around the current trading price. So we see a 20% margin of safety. In terms of Wall Street, their price target is slightly lower than the intrinsic value of $228. So they do still believe this to be a strong buy with upside of 17%. As always, when we run through these stocks, do let us know your thoughts in the comments below, whether or not you have been adding any of these companies or they make it onto your watch list. The next strong dividend increase is American Express. As we can see here, they have increased their dividend by 17% this year. They are up around 16% over the last year, and over the last 10 years, you would be up around 136%. They currently trade towards their 52-week high with a forward yield of 1.14% and a forward PE of 16. In terms of dividend safety, it sits at 80, safe score, market cap 152 billion, a mega cap company. Key recessionary metrics, well, they maintained the dividend during the last recession, below average growth, and significantly trailed the S&P with that negative 82%. As we can see, a nice double-digit increase in January 2024, 10% over the last 5 years, and again, another strong double-digit over the longer term. In terms of numericals though, well, they have only been increasing it for the last 2 years. As we do see here, they did maintain it in 2020 to 2021, but they have still been paying a dividend for the last 28 years without a reduction. Dividend yield theory, then we have a sense of reasonable valuation on the yield as well as the forward PE. And when we look at the financial sector PE, it does sit lower at 11. So let's take a look at the free cash flow payout. Pretty strong, in fact, around 10% over the last 3 years. Looking very good, so we can expect to continually see those strong double-digit dividend increases. And we see the free cash flow per share very inconsistent, but when you take a longer-term approach, it has been increasing more than 2 times. Sales growth then, double-digit, very strong over the last 3 years. We do note that COVID year in 2020 where it dropped, but if we do exclude that, overall it has been around that 3 to 7% at a bare minimum. And we can see the top line going from 32 billion to 56. They also do a lot of share buybacks, very nice to see. They've bought back over 300 million shares, so around 30% from 2014 to reduce it from 1.05 billion to 736 million. Now, when we look at the return on equity, we can see above that 10% level. It isn't consistent, but it is consistently above 10%, so that is nice to see. The last 3 years as well, very strong. Now, in terms of the net debt to EBITDA, 0.86 in the more recent year, 0.62 expected in 2024. So no real worries there with the dividend safety or with their balance sheet. So it does look to be a strong, healthy company at the moment. In terms of the valuation, let's get to the intrinsic value. And as always, you can grab a copy of the valuation model to get to the intrinsic value and the acceptable buy price of companies in your own portfolio or on your watch list by clicking on that pinned comment below. So we can see at a 10% margin of safety, you would be looking to buy around $200. So right now we see the intrinsic value at a margin of safety at around 5%. Now this isn't one that I would buy around a 5% margin of safety, but again, it does come down to the investor and their thesis. Wall Street and their forecast, well, they believe as well 1% upside, so they don't see much room for growth for American Express over the next 12 months. The next dividend increase is Eli Lilly. Now they increased their dividend by around 17% in December. Over the last year, they are up 112%, trading now at their 52-week high, and their yield is around 0.7%. Over the last 10 years, an incredible run up 1,182%. In terms of dividend safety, well, very safe, a score of 96, 668 billion, a mega cap company. Key metrics, well, they increased the dividend during the last recession, above average growth although they did beat the S&P but marginally with their negative 49% return. Dividend increase, well, 15% in December, 15% over the last 6 years, 6% over the last 6 years. A little bit inconsistent over the longer term, but nice to note over the more recent period, strong double-digit increases, and they have been increasing those dividends for the last 9 years. In terms of dividend yield theory, where we have that huge sign of overvaluation, 0.7 versus 1.51, and we can see the forward P significantly higher than the 5-year average. When we compare it, then the healthcare sector P is much, much lower at 16.9. When looking at their free cash flow power, it does give some red flag indications. Whilst it is very inconsistent, we see 2023 expected 286%, which signals in 2023 they expected to pay out more in dividends than generate in free cash flow. The only positive to note here is that in 2024 it is expected to come down to 51%. Free cash flow per share from 2014 to 2022, it has essentially doubled. A little bit inconsistent and a bit of a question mark as we do see it decrease in 2023, although we see some expected huge growth in 2024 at $10.20. Sales growth last year, very strong double digit, 20%. 2022, however, 1%. So overall, it is very inconsistent, but on the longer term, their top line is increasing at a strong rate, and we can see that here nearly doubled from 19.6 billion to 34 in 2023. They also do share buybacks very inconsistently. Nonetheless, they have bought back around 167 million worth of shares, 1.07 billion in 2024, 903 in 2023. ROIC, nice to note that it's above the 10%, but it has also been increasing very, very strong the last few years. Absolutely incredible, in the 30s, very consistently as well. And do check those free newsletters to see the other 6 golden dividend metrics when I look for undervalued companies. Operating margin been increasing over the last 10 years. Nice to note the efficiency is getting a lot better year on year. Free cash flow margin, whilst it is very inconsistent, I just want to point out that in 2023, it is expected to drop down to 4%, below the level we like to see. Although having seen their free cash flow expectations for 2024, we should see this or expect to see this back up to the strong double digits. Net debt to EBITDA, no real worries there. 1.5 in 2023, 1.21 expected in 2024, well below that 3. So we can see why that dividend does remain to be very safe. So let's take a look at the valuation of LLY, ticker symbol for Eli Lilly, and the intrinsic value is getting to $759. Now that isn't too far off the current trading price, and we can see with a 5% margin of safety, it still isn't a buy. So this is one that we would say has a 0% margin of safety and is trading pretty much at its intrinsic value. Wall Street on the other side, whilst they do see some room for upside, they only see around 4% with a price target of $771. The next huge dividend increase is none other than the Walt Disney Company, with a massive 50% increase to their dividend this month. Now, this is a company that is up 3% over the last year. Over the last 10 years, up 38%, and we can see all-time highs at around that $200 level in mid-2021. They're currently trading at their 52-week highs with a yield now of 0.3% and a forward PE of 24. Dividend safety now, given they've just started to pay back those dividends, we don't have a score just yet. Market cap 203 billion, a mega cap company. Now we can see here they did in fact stop paying dividends in 2020, restarted this back in 2022. So in terms of their payout ratio, we can see expected in 2023 around 7%, after that increase of 50% going up to 28%, which seemed to be the level it was before when it did start to pay those dividends to shareholders. Free cash flow per share, nice to note that it has increased to 268. When we had been reviewing this, we were expecting around this level, so nice to note that it did materialize. Although before the pandemic, around 372, it went up to 656, and then the subsequent years we did see it fall. 2024 is expected to increase as well to 321, which is nice to note, and hopefully they continue to grow those free cash flow per shares like they did pre-pandemic. Sales growth at the top line, we can see 7% in 2023 in the more recent year, pretty much in line again with 2014 to 2018, although we do note some negative growth in the top line. 49 billion then in 2014, 89 in 2023, and we do note both share buybacks as well as share dilutions. The net position over the last 10 years, however, would be share dilution, and they have issued around 700 million worth of shares. Now, In fact, it was around 70 million, not 700 million. ROIC over the last few years, it has been decreasing, though that shouldn't come as a surprise based on the metrics we have analysed above. Again, the positive to take from here that in 2021, it did look like it was towards the bottom, and it has been increasing year on year. Something just to keep an eye on, but hopefully we start to see those strong double-digit ROIC figures that we've come to love from Disney in the past. Again, operating margin has been falling pretty strongly, in fact, until 2021. Again, nice to note, both on the operating margin and the free cash flow margin, that from 2021-22, it has started to increase. 12% over the last trailing 12 months on the operating margin, 9% on the free cash flow margin. Does look like this company could start to be around the point of a turnaround. Net debt to EBITDA 1.99 in 2023, 2.04 expected in 2024. It is below the 3 we like to see, although we note it has gone above that in 2 years. Probably something just to keep an eye on, but no real big worries at the moment. In terms of the valuation then, which is quite important when analysing a company, you may look and it has incredible metrics, might be one to add to the watch list, but it is very key to buy at the right price. So we have an intrinsic value of $108, which is pretty much a few dollars shy of the current price. So similar to Eli Lilly, we do believe it is trading around its intrinsic value with 0% margin of safety. In terms of Wall Street, well, they have upside of 4% with a price target of $116. So this isn't a strong buy in my personal opinion, and it looks like that is the same of Wall Street with their price target. The next stock that did increase was PepsiCo, 7.1% this month, down 5% over the last year. Over the last 10 years, however, up 116%. And we can see their all-time highs at around $197, although they're currently trading towards the mid to lower end of the 52-week range. The yield is now bang on 3% with a forward yield of 21. Dividend safety score 93, very safe. Market cap 232 billion. Key metrics, well, they increased the dividend during the last recession above average growth, and they also outperformed the S&P with a negative 35% return. Increased 7% over the fact this year, 7% on average over the last 5 years, so pretty consistent, and nice double digits, 11% over the last 20. They are also a dividend king. They have increased those dividends for the last 50 years or more. In terms of dividend yield theory, we have that sign of undervaluation on both the yield as well as the forward PE, so a strong double undervaluation signal, but we do note the consumer staples industry sector PE of 18.7 is slightly lower. Free cash flow payout, something just to keep an eye on, as we did see here in 2022, it went over 100%. 23, 86%, a little bit too high for my liking. The issue I have here is over the last 6 to 7 years, it has been above that 70% industry specific free cash flow payout metric. 2024, although expected to come down to 77%, for me personally still a little bit too high, but something I would advise investors or potential investors to keep an eye on. Free cash flow per share, very inconsistent. It hasn't really increased massively over the last 10 years. All I would say is understand the type of investments you're looking at. Some will be fast growing, so you can have more expectations. Some will be more stable, more mature. Just adjust your essential expectations accordingly. Top line growth then pretty nicely over the last 6 to 7 years, 6% in 2023, looking fairly positive for this company, and numerically 67 billion in 2014 to 92 in 2023. They also do share buybacks. As we can see, they have lowered their shares outstanding, but not a massive amount, nothing really to discuss on that topic. Love to see this above that 10% and consistently year on year, very strong. In fact, the last 3 years at 19% is a very nice indicator that management are operating this company effectively and efficiently. Operating margin pretty much straddling around the minimum that we like to see, something again to keep an eye on, but nothing to note as it has been pretty much consistently around that level. Free cash flow margin, on the other hand, it has started to decrease. Again, just some areas to look forward to quarter on quarter, year on year. In better news, the net debt to EBITDA 2.03 in 2023, 1.9 expected in 2024. So no real worries there. We can understand why that dividend does look to be safe. So let's get into the valuation for today's episode, which is the average of these three models at $185. So we can see margin of safety at 10%, a buy at 166. So a few dollars shy of the current trading price. So based on our estimates and judgments, we do see essentially a 10% margin of safety. In terms of Wall Street, well, their expectation is upside of 11% with a price target of $187. We then move on to the next company with the dividend increase. Similar to PepsiCo, Tractor Supply Company increased their dividends by 7%. Over the last year, they are down 2%. Over the last 10 years, up 251%. And they're not too far off their all-time highs at around that $250 mark. Currently trading at that upper end of the 52-week range. Yield just under 2% and a forward PE around 23. Dividend safety 68, it looks to be safe. Market cap 25 billion, a large cap company. They didn't pay a dividend in the last recession, so no comparative data. They did have above average growth and also outperformed that S&P with a negative 38% return. 7% increase to the dividend this month, 28% over the last 5 years on average, 24% over the last 10 years, looking very solid. And they have increased those dividends for the last 13 years. So let's take a look at dividend yield theory. We have that sign of undervaluation on the yield, 1.89 versus 1.47. Although we do note the forward PE is more in line with the 5-year average of 21.5, but significantly higher than consumer discretionary sector PE of 14.4. Free cash flow pattern, a little bit alarming over the last 2 years, above that 60%, 70 in 22, 77 in 23. It is better to note, though, that in 2024, they're expecting to bring it down to 56%. Free cash flow as well has been increasing over the longer term. I do like to see that. Yes, it's not very inconsistent, but over the longer term, it is moving in the right direction. 790 expected in 2024 is also positive to see. Sales growth then very inconsistent, but again, just because a company is inconsistent, as long as the numbers are looking very strong year on year, that isn't a bad sign. The only negative to note here is that 2023, the more recent year, was the worst year of the last 10 years for Tractor Supply. Numerically, they're nearly 3 times their top line, 5.7 billion to 14.6. Shares outstanding, now they have returned quite a lot of excess cash to investor pockets. 139 shares outstanding in 2014, 110 in 2023. They've bought back around 29 million worth of shares, nearly 20% of the starting position in 2014. ROIC, yes, it is very inconsistent, but even the last 5 years are looking very strong. 21% in the latest year. It is something that I would say is very positive when analysing companies. Operating margin pretty consistently below the 12%. Nonetheless, given it is consistent and the last 4 years have been at 10%, I wouldn't say there's anything too bad to note here. Again, something just to keep an eye on. And probably likewise, the same to be said about the free cash flow margin, especially the last 3 years. 4% every single year. It is below the 5%, but as long as it doesn't go too far below that, then that should be okay. Finally, we look at the net debt to EBITDA, 2.48 in 2023. It's been increasing since 2021, but in more positive news, it is expected to come back down 1.89 in 2024. So nothing really too drastic or too bad to point out. So let's get to the valuation of Tractor Supply. As we saw, there was an undervaluation signal on dividend yield theory, and we get an intrinsic value of $253. Margin of safety then 10%, and remember, it has to meet those 3 criteria for us to use it. Wide moat, strong financial metrics, good forward-looking data. It isn't too far off a 10% margin of safety, so we would say Tractor Supply has around 5 to 10% at the current value. In terms of Wall Street and their expectations over the next 12 months, they see a price target of $242, upside of 4%. As always, let me know your thoughts about these companies that we run through, whether or not you're adding any of these, whether you're a shareholder and you're very happy with these dividend increases. And as always, have a great day. If you enjoyed today's episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And don't forget, if you want, you can grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list by clicking on the pinned comment below. Have a great day and see you on the next one.